Good evening, and everybody. I am Deputy Consul General Victorio Dimagiba Jr., and I will be your MC and moderator for this evening's webinar entitled Webinar on Setting Up Business in Canada, a Legal Perspective, brought to you by the Philippine Consulate General in Calgary. We are happy that we have around 31 individuals in the Zoom platform right now, and more will be coming in. Before we begin, some housekeeping rules. Please keep yourselves muted during the duration of the webinar. Questions are welcome to be raised at the Zoom chat box, and which will be read during the question and answer portion of this webinar. When writing your question, please identify yourselves. Before we begin, may we first call on Consul General Zaldi B. Patron of the Philippine Consulate General in Calgary to deliver his welcome remarks. Consul General, please.
Thank you very much, DCGV. Good evening, mga kababayan, and welcome to this webinar on setting up businesses in Canada, which is the Philippine Consulate General's latest project under our Economic Diplomacy Program. In recent months, the Philippine Consulate General has been very active in undertaking economic-related projects to assist Filipino-owned businesses and promote trade and investment between the Philippines and Alberta and Saskatchewan, the two provinces under our consular jurisdiction. We had the Canada-wide Filipino Restaurant Month in April 2022, and a few months later, the Philippine Trade Expo in Edmonton, Calgary, and Saskatoon in July to August. Since I arrived here in Calgary in 2018, I have seen an increase in the number of Filipino-owned businesses in Alberta and Saskatchewan. I believe this is a positive trend within our community as we see our fellow Filipinos getting more business-oriented. We thought of coming up with this webinar to educate our aspiring Filipino entrepreneurs on the basic steps in setting up a company in Alberta and Saskatchewan on a legal perspective. This webinar is meant to guide them and assist them in making their decision. For those who have already set up their own businesses, this can be a refresher session. Tonight, we are fortunate to have with us as our resource person, our very own Filipino-Canadian attorney Henry Villanueva, who is a senior business lawyer at the national law firm of Lindsay McCarthy LLP with offices at Calgary, Vancouver, and Toronto. He has agreed to share on a pro bono basis his knowledge on our topic today. As he will be introduced in greater length later, I would like to take this opportunity to thank Henry for sharing his invaluable time and expertise with all of us, which is his way of giving back to his community. This webinar is the first part of a two-part webinar that the PCG is hosting this month and next month. On 18 November, we are also organizing a webinar on Philippine franchising, where we will have experts who will explain to us how to franchise Philippine brands and what are the Philippine companies interested in opening branches in Canada. Tonight, we will provide you with the information on how to set up businesses in Canada. Next month, we will share with you some leads that may open franchising opportunities for you. So please follow the Facebook page of the Philippine Consulate General as we will announce in the coming days the details of our webinar next month. Meanwhile, I hope all of us will have an extremely informative and productive session tonight. Maraming salamat po.
Thank you, Consul General Patron. Moving forward, may I now introduce our guest speaker for this evening. Mr. Henry Villanueva is a senior business lawyer at the national law firm of Lindsay McCarthy LLP which has offices in Calgary, Vancouver, and Toronto. He advises on complex corporate commercial transactions, banking, financial services, and real estate matters. Henry obtained his Juris Doctor law degree from the Ateneo Law School and is a member of the Law Society of Alberta, Law Society of British Columbia, the Integrated Bar of the Philippines, and the Philippine Institute of Certified Public Accountants. Henry is proud to support his kababayans and contribute back to the Filipino community in Canada, and is a board member of various local nonprofits and charities. Attorney Villanueva, the virtual stage is now yours.
Thank you so much for that, Vic, and thank you for the warm introduction. Thank you to the Philippine Consulate Office here in Calgary for this opportunity for me to be able to share what I can with the Filipino community and to assist you in setting up your businesses here in Canada. So what I will be doing for this evening is going through with you the process on how to set up your business in Canada, and I'll focus more on the legal perspective. Of course, there's differences between provinces in Alberta and Saskatchewan and other provinces throughout Canada, but I also want to emphasize that the process is also different based on the industry you are getting into. So if it's a restaurant versus a manufacturing company versus a services company, there's different avenues for you to reach out and establish and get permits and set up your business that way. So I will focus on the legal perspective. Next slide, please. So our outline for this afternoon, or this evening rather, is sevenfold. So my presentation is composed of 10 slides, and I will discuss it by going through the following. First, I'll discuss with you business structures. Second, what are the considerations in setting up your corporation? Third, governance and structure. Fourth, shareholders, directors, and officers, and the difference of each of these items or positions. We'll also touch upon number 5, financing and banking, as well as 6, landlord and tenancy matters. And number 7, we'll touch on employees or independent contractors, because when you're a business owner, you definitely need to take into consideration those 2 characters who will assist you in growing your business. Let's take a look at the first slide. So in Canada, there are various types of laws. The first class of laws are what we call federal laws that encompass laws that are to govern regardless of your province. So these are Canada-wide laws. And for business purposes or business law, Canada federal laws governing businesses is the Canadian Business Corporations Act at the bottom. But specifically, when our discussion for this evening is going to be about Alberta and Saskatchewan, we have to talk about the Business Corporations Act Alberta, RSA 2000, as well as the Saskatchewan Business Corporations Act, RSS 1978. So keep at the back of our mind that when I'm going through these slides, these are the main basis or the laws that govern setting up a business here in Canada federally, as well as provincially, Alberta and Saskatchewan. So these are for your reference only. Next slide, please. So the first slide that I would like to discuss with you is business structures. So essentially, this includes discussions on the various forms of businesses that you may choose to set up when you're starting out or building your business. And there are 3 main types of those structures. The first is the sole proprietorship. The second is the partnership. And the third are corporations or corporate entities. Now let's take a brief look at the pros and cons for each of these and why and when would you choose one over the other. Sole proprietorship. So sole proprietorship is the easiest form of business structure to set up. It is inexpensive and you're able to use trade names. An example of this is you as an individual. For example, you're very good at cooking and you want to set up your restaurant. You can set up your own sole proprietorship. You don't need to go to any registry. You may want to set up a trade name and put a pseudonym or a doing business as for your restaurant. And the reason it's easy to administer is because you are your own boss. It is inexpensive. You don't need to prepare any filings at corporate registry. And all you may need to do is set up a trade name or choose what applies for your restaurant best. Now, the cons or the disadvantages for a sole proprietorship are the following. First, personal liability. Of course, since this is your own business, you are liable for all debts of the business. So you will owe your suppliers, you will owe your providers of equipment and goods and services, you owe them personally. So if your business cannot pay, of course, you as the sole owner is liable to pay those liabilities and debts. Another challenge with respect to sole proprietorships is raising money. Now, when we set up businesses, there are times where you would need more capital for purposes of growing your business. Now, since this is a sole proprietorship, you're limited to your own personal finances. And that's one of the constraints or challenges that my sole proprietorship businessmen have to deal with. They have to raise money from their own pockets. Another disadvantage of sole proprietorship is the lack of coverage. So what does that mean? What that means is because you are your own boss and you run the whole show, you are the main dishwasher, cook, server, and everything, there's an issue with respect to coverage. And what I mean by that is, what if you want to go to the Philippines for vacation? You need to look for someone who can continue your business for you while you're away. So that is occasionally one of the problems for sole proprietorships, having to look for other people, friends and families to look after your business while you are away or while you are sick as well. The next type of business structure is the partnership. So partnership is comprised of two or more individuals with the common goal of doing business and making a profit. So what that usually entails is drafting what's called a partnership agreement. And in that partnership agreement, you discuss with your partner how you will split profits and losses, how you will run the business, his roles, his responsibilities, and what you will do for the business as well. So in the partnership agreement, it's very important to differentiate your roles and responsibilities, but also set expectations on what you expect from each other. Will your partner be a silent provider of service, or will they be actively involved in the business? Another point you have to consider for partnerships is general or limited partners and the concept of mutual trust and confidence. So when you have a partnership agreement between you and your three friends, for example, you have to assign roles for each, but at the same time, authorizations for each. Are we all authorized to sign and withdraw money from the bank? Or are we only giving that to one or two of our partners? So that's something you have to consider. Another point for partnerships is the concept of a general and a concept of a limited partner. So general partners are liable to a greater extent than limited partners. So sometimes partners might only be capital contributors or just giving money for the business or the company, while other partners are more involved with actively managing the partnership or business. Now, what you have to consider as well with partnerships is complementary skills and talents and shared decision making. So of course, if one of your partners is an accountant, we better make sure that they're the individual taking care of the books and filing of the taxes. If you have a partner who's more front of mind as far as operations, then it's better that they do the operations side of the business. So this is taking advantage of the strengths and minimizing the risks or weaknesses of certain partners. And that's what the partnership does. The next and most important form of business structure are corporations. So now this is what I am going to get into further details in this presentation, but suffice it to say that a corporation is always recommended because of what's called limited liability. A corporation or corporate entity is separate and distinct from the personality of you and your partners or founders or other business associates. So Mr. A, B, and C is different from Corporation A. If Corporation A is unable to pay debts, as long as Mr. A, B, and C did not provide a personal guarantee, then those debts do not flow to the shareholders or business owners. Now, what you need to be mindful of for corporations is what's called a unanimous shareholders agreement. So similar to the partnership where partners come together to make an agreement, the corporate shareholders should also come together and make an agreement that will spell out their rights, duties, and expectations from each. We'll get into the corporations in the next few slides, please. Number 2, considerations in setting up your corporation. So now we've decided, for example, that our business is not going to be as simple as a sole proprietorship. We do have partners. We're more than one. Let's say there's 3 friends who want to set up a corporation. Now, what do these 3 friends need to do to set it up? What are their next steps? So the laws in Alberta and Saskatchewan provide that there must, of course, be a corporate name. So the laws in Canada require you to use corporate name identifiers like Corp, Incorporated, Corporation, but you must also provide for a distinct corporate name for your entity. And in Alberta and Saskatchewan, you need to execute what's called a nuance search, where you go to a registry and they search the name that your corporation can be named as. Occasionally, some names are already taken, so it's highly recommended that you provide at least 2 or 3 names in order of priority so that the registry can check which is available and you can choose which corporate name you want to use. Now, be mindful when you choose a corporate name, choose a name that's also descriptive of your business. You don't want your name to sound like a restaurant if it is a manufacturing or service company, and vice versa. So if it's a restaurant, make sure you add descriptors that could include your name or restaurant and so forth. So be mindful in those name searches and choosing of your name. Now, when you incorporate a corporation, you need to file what's called Articles of Incorporation. Now, Articles of Incorporation is essentially the legal document that lists down the name of your company. Aside from that, who the founding or initial directors are of your company, as well as a schedule of shares. Now, the schedule of shares basically lists down the class of shares that the corporation will be issuing. So these could include common voting shares, preferred shares, non-voting shares, and other similar types of shares that you may issue to, for example, letter D, investors, family members, and key employees. So what's good about setting a corporation is you have the ability to designate different shares for different individuals. And what that means is you and your 3 friends as founding shareholders can be issued Class A common shares, but you can also have the ability to issue shares to investors who are not actively involved in the company. They are merely providing capital. You can also issue shares to family members, so you can take advantage of lower tax brackets for those family members, especially if you have young adult children who may want to get involved in your business as well. You can also issue shares to key employees to motivate them. So a couple of my clients have issued shares to their key employees with the prospect of these key employees taking over their business in the future, so that they will have a stake or interest in running the business should you choose to retire in the future. So the beauty about corporations is that it is very flexible. You and your founding friends are the founder shareholders, but you can also issue shares to other individuals who may later on get involved with the corporation in different capacities as investors, family members, and key employees. So these are your prime considerations when setting up a corporation. Next slide, please. When we set up a corporation, we also have to be mindful of governance and structure. Now, what does that mean? When we talk about governance and structure, this is how your corporation will be run. Okay, so corporate entities should have what's called corporate bylaws. Now, corporate bylaws provide for many things, and you can customize your bylaws depending on how you want your corporation to run and the operations of your company as well. But most commonly, bylaws discuss housekeeping, meetings, and formalities. So housekeeping is essentially who will do what and what are the roles and responsibilities of the shareholders, directors, or officers. So typically, the bylaws will include what the roles are for the president of the company, what the roles are for the secretary, the treasurer. It will usually list down who the initial directors may be as well. But it also lists down the requirements for certain meetings. So the Alberta Business Corporations Act has mandatory meeting requirements for corporations, which include an annual meeting of the shareholders, meaning the shareholders must have the opportunity to meet every year. And the directors have a responsibility to share with these shareholders financial statements of the company to show the profitability of the company as well as how it has been run efficiently. Also, formalities are included in the bylaws which would also state certain timelines. If notices have to be given to certain individuals or shareholders, or notices have to be given if you're buying or selling shares of the company. So again, bylaws are important so that you can properly govern the corporation as well as to properly structure the affairs of the corporation. Now, this is very tricky as well because bylaws can be customized to be as detailed as you need it to be, or it can be as simple as you want it to be as well. But take note, throughout the life of the corporation, the directors have the ability as well to modify or update the bylaws throughout the life of the corporation. So keep in mind governance and structure, and always remember that corporations need to have bylaws to put this in place. Next slide, please. So let's talk about a couple of characters with respect to corporations. So corporations are primarily composed of shareholders, directors, and officers. So let's talk about each of these characters and how they relate to each other. Okay. The shareholders, as what we discussed earlier, are owners of the corporation. They could be you and your three friends, the founding shareholders. Okay? They could be your family members who were issued shares as well, or investors who were issued non-voting shares. They could also be key employees who were issued shares to motivate them to be more involved as well. So remember, when we talk about shareholders, these are the owners of the company. Now, the shareholders every year have the chance to do what's called a vote of directors. So when shareholders each year vote directors, they're actually voting who are the primary strategic players of the corporation, who are the directors. So the directors are essentially those individuals who play the strategic role in the direction of the corporation. Now, I'll tell you this. If a corporation is just comprised of, let's say, two shareholders, Mr. and Mrs. Smith, for example, Mr. and Mrs. Smith can also be the directors. So they can be the same characters or individuals, but wear two hats, as shareholders and as directors. So they are owners of the company, but at the same time, they're also directors of the company, and they provide for the strategic growth of the company. Let's talk about the next character, who are officers. So officers are essentially those who govern or who attend to the day-to-day needs of the company. And now these officers come in many different forms of names. They can be your president, vice president, secretary, treasurer. They can also be called CEO, CFO, vice president, finance, vice president, operations. Any corporation through its directors can name and appoint any or however so many officers as they need in order to run the business. So in a small business of, let's say, just 3 or 4 shareholders, those 3 or 4 shareholders might appoint 3 directors, for example, who will govern the corporation strategically. But those 3 directors may choose just 2 officers, a president and a secretary treasurer. So this goes to show that the shareholders do not necessarily need to be the same directors or officers. They can be less, and they can be everyone as well. So again, just to recap, shareholders are the owners of the company. The shareholders vote the directors. The directors then appoint who the officers are. So that's the hierarchy of each shareholders, directors, and officers. Now, letter B, unanimous shareholders agreement. We touched upon this earlier, and I always emphasize this to my corporate clients, the importance of what's called a USA. Now, when you and your friends form a corporation, everybody is motivated to do good, grow the company, earn profit, earn dividends, and make the company financially viable and feasible. That's everyone's plan when we set up the corporation. And that's true and good as well. And because you're all friends, you all understand each other and you want to make things work. But I'll tell you this, life happens. And occasionally you will have a shareholder, director, or officer who, let's say, moves away from Calgary and has to move to Edmonton, or has to live with their family in Vancouver, or needs to move to another job in Toronto. So these are certain corporate events that change the composition of the company and change the dynamic. And that's what these USA agreements relate to or assist in figuring out. So these USA agreements discuss what will happen if one of your shareholder friends or directors passes away or has to leave the company. What will happen to their shares? Will their shares belong to their wife, or will their shares belong to the company when the company buys it back? So these USAs are important to make sure that the company knows what to do should those situations arise. Another sticky issue for USAs is the issue of valuation. So when you set up a corporation and you're a shareholder, you can't force the corporation to buy back your shares. You can't force the corporation's other shareholders to buy your shares either if they don't want to. So if you put in $10,000 as a shareholder, you can't go to your partner and say, you must buy my shares out if they do not want to. And that's where a USA comes into play. It provides for mechanisms that will provide for what are the value of your shares, how the value increased, and also what will happen if a shareholder wants to be bought out or exit the company. Another issue that USAs deal with is dispute resolution. So it's fine and dandy in the beginning, but again, as I mentioned, there may be challenges down the road for you and your friends as shareholders, and they might be conflict. So if there's a conflict between shareholders, occasionally the USA will provide for clauses that will resolve that conflict. An example of that is who will buy out who and for what amount. Now, the risks for corporations and shareholders, directors, and officers are the following: piercing the corporate veil. What that means is, remember I told you that if a corporation has debts, it's not necessarily the debt of the directors or shareholders. That is correct in general. However, there may be a situation where the veil of the corporation is pierced. And what I mean by that is if directors act beyond the scope of their power or authority, they may be liable similarly to the corporation. So this is to make sure that directors, officers, shareholders act within the bounds that they're allowed to. Otherwise, they will be personally liable. Another point with respect to risks are those lawsuits. Now, it's always good to build a corporation because it shields you to a certain extent from lawsuits from customers who are not satisfied with goods or services of the company. But I'll tell you this from experience. As a corporate lawyer, I deal with a lot of litigation. And when this comes into play, plaintiffs or those who want to sue the corporation do not just sue the corporation, but they will also sue the directors and officers based on their capacity as well. However, if the plaintiffs find no reason for you to be liable personally, then the lawsuit will be dropped against directors and officers and only be maintained against the corporate entity. So these are the risks as far as being shareholders and directors of a corporation. Next slide, please. So as your business grows, I'll tell you this, the next step that you will want to do is to raise more capital, to expand your business, to buy more equipment, to be able to build more branches, and to be able to hire more staff as well. And in these cases, this comes into play, financing and banking. So the question here is, as a business owner, how do I raise money or capital? Of course, the first answer there is through business loans. Now, business loans are essentially the corporation borrowing money. It's not you borrowing money, it's the corporation, because again, you want to limit your risk. So for business loans, the easiest, fastest way to obtain these loans is through family members. You can touch upon mom or dad, or aunts or uncles, or brothers and sisters, and issue promissory notes to them for 10,000, 50, 100,000, depending on what they're comfortable with. But remember, promissory notes must also take into consideration interest payments and the term or how long they will be paid for. So these are the easiest form of loans through your family members. If you've exhausted the family members, there's no more mom and dad, aunts or uncles, everybody has already lent you money, you've maxed that out, the next lender could be the banks. Now, I'm a banking lawyer and I'm lawyer for RBC-TD, all the major banks here in Alberta. And what I do is I assist these lender banks with the review of their commitment letter, credit and loan facilities, and repayment terms. So I know what the banks look for before they are able to lend money to businesses. And I'll tell you this, what you need to show the banks are primarily your business plan, what the money will be used for. You need to show them as well that your business is profitable. Ideally, the banks will want to look at 2 or 3 years of prior years' financial statements, but they want to see that you have revenue. They want to see that there's money coming into your corporation, there's sales of the corporation, and that you know what you're doing and you have the experience to grow your business. So these are items that the banks look at to determine your creditworthiness for them to be able to lend monies to you. Based on my experience as well, if you're borrowing from these banks, they will require you to have skin in the game. And what that means is you'll need to provide at least 25% of the loan amount to show that you have skin in the game and the bank is not financing 100% of your endeavor. So those are primary considerations for business loans, family, and of course the bank. Remember, the bank is not there for free either. So you have to also take into consideration the interest rate that the bank will charge you. And as we go down later, security documents. So letter B, due diligence and security documents required. So the bank, of course, it is their job to do a background check as far as your business. And depending on the financial standing of your business, they will require collateral from you. And what this collateral could be is a mortgage, and they'll also ask to register liens in Personal Property Security Registry, and they will likely ask a personal guarantee from the owners of the company. Okay, so mortgage, if your business owns a shop or a bay, they'll ask a mortgage on that. They may also ask for a mortgage on your home if you're comfortable giving that. They'll also ask for registration at PPR or Personal Property Security Registry, and this is similar to when you buy a car and you don't pay in cash. The shop will register a PPR against your car. And of course, personal guarantees, meaning if the corporation doesn't pay, then the business owners will pay the loan to the bank. Note as well that when we're doing banking and obtaining loans from the banks will also ask conditions and covenants from you. So conditions are, what is the condition of the loan for the bank to continue to lend you money? And the covenants are, what do you promise to give to the bank, or what will you do to make sure that the bank will be kept comfortable lending you this money? So covenants could include restricted uses, meaning we're going to send you or lend you $500,000, but you're only allowed to use this for the purchase of equipment and $50,000 for operating capital, for example. You can't use that to go on a trip, for example. You can't use that for your personal expenditures. You can only use it, for example, for business purposes. So that's restricted use. Covenants include an annual reporting or obligation. So since the bank lent you $500,000, you need to make sure that it is profitable and the bank, you'll be able to pay the bank in due time. So the bank will usually ask you each year or semi-annually or quarterly to provide financial statements to show your sales, your expenses, and how well your business is doing. So this is financing and banking. Next slide, please. Let's talk about another situation for businesses. So of course, when you have your business and you don't have your own a building or commercial bay, what you'll need to do as a business owner is, of course, lease or be a tenant or look for a location where you can do business. And that's where these issues of landlord and tenancy come into place. So typically, when you're a business owner, you enter into what's called a commercial lease agreement to rent space. And some of the items that you will need to consider are identification. You need to identify who the parties are, when will your lease commence, possession date, and the premises. Is your premises sufficient for your business? If it's for a restaurant, do you have sufficient seating area? If it's a manufacturing business, do you have vents sufficient for the production? If it's a service business, do you have enough cubicles for, let's say, call center agents? These are things that you have to consider. You also have to consider the contractor with respect to them doing work on the premises that you're renting out. Letter B is the dollar signs, or you need to know how much you're paying as far as rent. So this is very important. So similar to paying rent on a house, you need to determine what is the rent that you're paying the landlord. But take note, for commercial leases, there's no simple solution or answer to a rent because there's also additional rent. So if you're renting 800 square foot, it could be 15, 16 per square foot, but there's also additional rent for common area costs, like for the use of the elevators, for the use of washrooms, corridors. So these are called common area costs, and these are in addition to the rent. So be mindful of those amounts when you make your budget with respect to dealings with commercial leases. With respect to escalations, security deposits, and free rent, when you're starting off in a premises, you can negotiate a certain number of months to be free rent and negotiate, increases or decreases in security deposits as well. So you could negotiate, let's say, 3 to 6 months of fixturing where you're gonna do construction. And then after you do your construction and open your business, you can negotiate, let's say, an additional 3 to 6 months as far as rent-free in the premises as well. So these are all negotiating points, but certain terms, of course, are more negotiable and more flexible than others. Letter C, term, extension, and renewal. So be mindful of this. Are you signing on to a 5-year lease, 10-year, 15 years? If it's a 5-year lease, do you have 2 extensions of 5 years for each extension? And how early or how late are you able to renew? So these are items that you have to consider as well in your lease. Condition of premises, again, if you're leasing bare premises, then you have to do construction to make it into the business premises that you wish to conduct. And some improvements are done by the landlord and some are done by you as the tenant. So make sure you're mindful to tell the landlord if they're going to be doing the walls and all you'll be doing is partitions or washrooms or HVAC, because these expenses are pretty pricey. So be mindful of those. So alterations, improvements, repairs, and service calls as well. Next slide. So again, just continuing on with landlord and tenancy. What you have to be careful of as well are clauses of default. So I did a lot of this when back in the pandemic, we had quite a few clients who had to renegotiate their leases because they were in default because, of course, their business was closed. And in the pandemic, if you have a closed business, you can't collect and you can't pay rent. if you can't pay your rent, then you're what's called in default. Okay, so when you're in default, it's not good for you. The landlord can call all of your rents for the 5 years, for example, in a worst case scenario. And that's why I recommend, even in the beginning, you have discussions with your landlord on pre-termination. So if, for example, your business grew so fast that within 3 years you need to move to a bigger space, you have options to pre-terminate your lease. So let's say giving the landlord 3 months advance rent for feeding your deposit, but at the same time, the benefit is they're not going to run after you for the remaining 5-year or 10-year term of your lease. So pre-termination. Also, another option for businesses who want to get out of their lease is you can assign or sublease. So if your space is too big and you want to downsize your space, you have the option possibly to sublease a section of your premises to another company who can take advantage of a smaller space. Or if you really want to leave your premises, you might be able to assign it to another business who will take over the whole premises altogether. So that's assignment and sublease. But of course, these are required to be with the landlord's consent. So those are in cases of default. So again, when you do your leases, make sure you take these into consideration. Also make sure that you know and the landlord knows what your permitted use is and what the restrictions are. So if the landlord has authorized you to use this space as a restaurant, the landlord will not be very happy if you're using the space for a money remittance, for example, or you're using the space for a sports facility if they are not permitted under your lease. If you do these things, you could be in default and the landlord may chase after you for the amount of outstanding rents. So be very careful there. Also, last item with respect to landlord and tenancy is insurance, indemnity, and dispute resolution. So as a tenant, be sure you have adequate tenant insurance. And the landlord will always require that you indemnify the landlord if, for example, you are leaving the premises and you need to do repairs. Make sure you're mindful of those as well. And if there's any conflict, usually this is resolved by mediation or you and the landlord talking to each other on how to fix these problems between the parties. So that's landlord and tenancy as well as commercial lease agreements. Next slide. The next slide, or the last item here, is employees or dependent contractors. So as your corporation grows and grows, it's not just going to be you and your 3 founding shareholders who are going to be involved in the company. When your corporation grows, you will need more and more help. But if the help does not come in the form of additional shareholders, they might come in the form of employees or dependent contractors. So let's take a look at this and what would be best for your company. So the easiest, of course, would be independent contractors because you don't have to pay specific benefits like EI, CPP, and so forth because they're their business of their own. But with respect to employees, of course, there's laws that govern employee-employer relationships. And you also have to deal with, let's say, workers' compensation if that applies to you. So there's pros and cons with choosing employees over independent contractors. So employees, remember that you have to provide your employee share of mandatory contributions. For contractors, they are their own businesses and they should be liable or responsible for their own taxes and their own individual contributions to EI, CPP as well, if that applies to them. So letter A, specific agreements. Of course, if it's an employee, you have to make sure you have an employment agreement. And in that employment agreement, you have to specify their position. Are they the branch manager or are they receptionist? What are their duties? You have to list those down so that if there's a conflict or issue, you know if they're following their duties or not following their duties, or if they're doing more or less than you expected from them in the beginning. So expectations as to duties are very important. The next item is term. So for independent contractors, you can say that, okay, I only need you for a certain project and you're going to be with me for, let's say, 6 months or to a year. Whereas for employees, it's more or less on a continuing basis with, let's say, a 3-month probationary period. Next item, compensation, increases bonuses and incentives. Of course, you need to spell out very clear. For employees, what is their base pay? Are they entitled to increases every year? What is their bonus structure, if any? As well as what are their incentives, or will they receive commissions in that specific instance? For independent contractors, it's more or less what is the hourly rate, or will they be paid monthly as well? Benefits. Employees typically are entitled to extended healthcare benefits, while independent contractors are not. So employees will have physio, chiro, dental, while independent contractors will typically have their own Blue Cross. Vacation. So independent contractors are, of course, to a somewhat extent, no work, no pay, while employees are entitled to mandatory vacation benefits according to laws, parental leave, maternal leave, and statutory holidays as well. For reimbursements, again, employees, if they are able to reimburse their cell phone or mileage, they should be able to, as well as independent contractors, if they paid things on behalf of the corporation, they should be reimbursed for those. And termination. So for termination, this is very important to consider and be very careful, because as business owners, you could be liable to be sued if you do not do this properly. So for employees, there's what's called without cause and with cause termination. So if you're terminating an employee based on dishonesty, fraud, or terminating for cause, then the notice periods are shorter, or you could immediately terminate them if it's for cause because you're protecting your business. But if you're terminating your employee without cause or for no justifiable reason, because you're downsizing, for example, you may need to provide the mandatory common law and statutory notice period. So these could be, let's say, 2 weeks for every year of service, or depending on the position of the employee or the responsibilities, it could go higher according to case law or the court system. Again, we talked about taxes, EI, CPP, independent contractors are responsible for their own. You as business owner are responsible for the payment of the withholding income tax for your employees, as well as their EI and CPP contributions from an employer and an employee share. For employees and independent contractors, be mindful as well of the concepts of confidentiality, non-competition, and non-solicitation. So with the worst that could happen is you have a key employee, you taught him or her everything they need to know to run the business properly. They've been with you for 10, 15, 20 years, and then all of a sudden, the loyalty or the relationship breaks down and they set up their own business and they steal your secrets. So again, you want to make sure that they've signed confidentiality agreements to make sure that your intellectual property is protected. But you may also want to enter into non-competition agreements so that they will not compete against you, and non-solicitation agreements so that they will not poach your employees. So I've had situations where employees set up their own business and then they poach the accountant, or they poach the branch manager of their previous employer, and that cripples the business. So be mindful when you have employees and independent contractors to enter into agreements with them, such as the confidentiality, non-competition, and non-solicitation agreements. So those are very important to protect your business. So that's for employees and independent contractors. Next slide. So again, as a caveat on suitability, certain concepts and ideas presented today may not be suitable in your situation or circumstances. I caution you to ensure that you obtain further information and professional advice, please. And the next slide. So the next slide, I'd like to open this for questions. Again, just to recap our outline or what we have discussed for today. We discussed business structures, sole proprietor, partnership, and corporations. We discussed considerations in setting up your business, the name, articles of incorporation. We discussed governance and structure, meaning setting up bylaws. We differentiated between shareholders, who are the owners, directors whose strategic direction, and officers' day-to-day operation. We also talked about financing and banking and borrowing from family or borrowing from the bank. But borrowing from the bank has strings attached, such as interest rates, covenants. We talked about landlord and tenancy. We talked about, tips for negotiating rent. And the last item, we talked about employees or independent contractors, the pros and cons on whether to hire employees or whether to hire independent contractors for your business. So that's a brief recap or outline. Now, that's it for my presentation this evening, and thank you for listening. And we would be glad to open the floor for questions.
Thank you very much, Henry. I think that was a very good explanation of the topic at hand. And I'm sure our listeners and our viewers tonight have been able to learn a lot more about what it is to set up a business here in Canada. So, well, actually, while we're waiting for questions from the chat box, where we are getting, of course, some of our friends are saying that it is a very informative session. I guess people are just a little shy right now. So maybe to start a question, you mentioned about how to the basic structure of how to begin setting up a business. How being not being a business person, how fast would it be able to set up, say, here in Alberta, a business from the time you submit your papers until the time you can be able to operate?
Definitely. A very good question. Thank you for that. So in Alberta, it's very fast, tantamount to instant. So when you have a corporation name, what you do is you ask your friendly lawyer or your friendly neighborhood registry to do a search on the corporation's name, and they can do that pretty much instantaneously. So you will know if the corporate name is available, and if it is available and you and your friends are firm with the corporate name, you can already register that at the same time. So what that means is the registry or the law firm will ask you who are the founding members, directors of your corporation, their addresses. They'll ask for a copy of their ID, and they'll draft articles of incorporation, and they can be registered, signed the same day as well. So if you are really in a rush, all of this can be set up during the very same day that you and your friends came together and chose a business name. So it can be done instantly. Now, that's with respect to registering your corporation. It's another story about getting business license and permits from, let's say, the city of Calgary or from Regina or Saskatoon. They have their own process for business licensing. And of course, as a business owner, you'll also need to set up bank accounts. So once you've registered your corporation, the next thing you would need to do is bring those documents to the bank, and with your friendly bankers, set up corporate bank accounts as well. So the quick answer to your question, of course, is instant. You can set up your corporation the very same day.
All right. Thank you very much, Henry. I got two questions here in the chat box. One is from MC11 Christine. Is there any disadvantage to registering the corporation online, as there are online services available?
That's correct. So I do not recommend it being done online because there's less guidance that they give you. Usually the registration online is the Canada or federal corporation, which if the purpose of your business is not to do business across the board, Vancouver to Toronto, you might not need a Canadian federal corporation. If the operations of your business will be limited to just Alberta or to just Saskatchewan, then you may prefer to register a local Alberta or a local Saskatchewan corporation instead of an across the board Canadian corporation online. So that's the disadvantage of the online. It may likely be an online registration for a Canadian federal corporation, and you may not need that. So be mindful. Am I registering an Alberta corporation or is this a Canadian corporation?
Thank you, Henry. From Irvin Bautista, for financing, there are lenders that are requiring the shareholders to act as guarantors to be liable simultaneously with the corporation. Is there a way for the shareholder to shield themselves from this liability?
So if the lender or the bank requires that the shareholders provide a personal guarantee, that's their requirement. And we cannot get away from that. Okay, what that means is if the corporation cannot pay the loan of 250, the shareholders are going to be, the bank is going to run after the shareholders for the 250. Okay, however, here's tips from a banking lawyer. So I've had it where my new corporations have shareholders as personal guarantees because they're new, but after the corporation has built a stronger balance sheet or income statement, you are able to negotiate with the bank on the third or second year for the shareholders' guarantee to be removed or to be decreased. So typically the banks will want an unlimited guarantee from all the shareholders. But as your corporation's financial strength grows, you can say, well, you know what, bank, let's limit my guarantee to just 50,000. Okay. Or, you know what, bank, can you try to check our credit for our company again? And if it's sufficient, remove our shareholders' guarantee. So these are items that you can negotiate with the bank, and it depends on the strength of your corporation as well as your relationship with the bank managers.
All right. Thanks, Henry. Next question is, if you have a corporation, can we use/borrow money from the business?
Definitely. And that is very common. So corporate entities are, of course, made up of shareholders, as I said, who are the owners and directors, strategic direction, and officers. Now, if the corporation, let's say, has retained earnings or a big bank account that it's not using, it can lend money to its shareholders. And typically, from an accounting perspective, it's booked as what's called shareholder advances to or from shareholders. So as shareholders, you can borrow money from the corporation, and that's not taxable, wink, wink. Or you can also lend money to the corporation depending on interest rates or terms that you so choose to do so. So you can be the lender to your corporation if you want to.
Okay. Well, thank you, Henry. Next question from MR. Can you register a business offering different services, for instance, financial and cleaning services?
So I don't recommend that. And it's because from an accounting perspective, when you do tax filings and when you do financial statements, it's going to look bizarre where you show revenue from cleaning, revenue from financial services. And that's not commonly done. It can be if it's a one-off, but if the operation is consistently doing, let's say, cleaning and lending, it's not a related service to each other, and it's not recommended. So to answer the question, can it be done? Yes. Do we recommend it be done? No.
Very straightforward, Henry. Thank you very much. I think that's actually the last question we have here. Oh, sorry. One more last question for you, also from Irvin. So with your indulgence, Henry.
Oh, for sure.
So,
no worries.
Say, for example, I established an Alberta corporation. Over time, my business expanded in several provinces. Should I make a new registration under the Canada BCA? Or how should I register my Alberta corporation under the AB BCA to Canada BCA?
Very good. And congratulations on the growth of your business. I deal with this quite regularly. So when businesses grow or when they have operations outside of Alberta or outside of Saskatchewan, what the next step is to get into, let's say, the Manitoba market is called a registration for extra provincial registration. It's called an EP registration outside your local jurisdiction. So example, Alberta Corporation does more and more business in BC and wants to expand in BC. You do an extra provincial registration of the same Alberta company into the BC registry. So you don't change your name, you just do a registration in BC of your Alberta company, meaning it's doing business in BC, it's registered in BC, but you're declaring that it has a home jurisdiction or home province being Alberta, where it was originally set up. And for tax purposes, that's also what you would provide in the tax returns for your corporation, that it is originally an Alberta company, but extra provincially registered in BC or Manitoba. So
Right.
no need to set up a new Canadian federal corporation, just
Right.
extra provincially register.
All right. Thank you, Henry. So I think we're down to the last three questions. So this is actually a follow-up from one of the previous people who asked, should we then return the money at the end of the year for tax purposes, since you said it is not taxable?
So when you do shareholder loans or advances, the advance to the shareholder is essentially the shareholder borrowing from the corporation. Okay. Now, it doesn't mean that you don't pay the corporation back. Okay. And at the same time, the money that the shareholder borrowed is money that was earned by the corporation, in which the corporation is subject to paying taxes. Okay. So take note as well that at the end of the year, or whenever the directors decide, the corporation has the ability to issue dividends to its shareholders, for which a dividend tax applies. So again, when you want to take money out of the corporation, it's done through three ways. The first is you declare a dividend subject to dividends tax. The second way to take money out is via employee salaries, which you will be taxed according to your personal tax bracket. And the third is by means of shareholder loans. Shareholder loans, again, are the company lending money to shareholders, but at the same time, the company also has to pay interest to the shareholders. So the easy answer to your question is, depending on how you booked the shareholder loans, taxes may be due, but minimal taxes.
Thank you, Henry. Next question, from an accounting perspective, is it an acceptable practice to calculate the possible dividend based on the advances to or from the shareholder account?
Yes. So that is something I urge you to have a more detailed discussion with your corporate accountant, because at the end of the year, you as directors of the company should be able to do some tax planning to minimize the tax of the corporation, but at the same time, to minimize the tax that the shareholders will have to pay because of dividends or employee withholding from income tax. So very good question.
Right. Thanks, Henry. So we're going to the final stretch. I registered one business under Retail's online store, and next year in March, I'll be opening a salon. Should I register two businesses in different business profiles?
Yes. So again, these are unrelated. So I would encourage that you register two businesses to differentiate them. It doesn't mean that you have to. You could have a single business that does both, but it shouldn't be the main operation of the business. Again, the main operation should either be the salon or the other form of operation. It shouldn't be both, because they're inconsistent as far as business operations.
All right. So I think we should be wrapping up. So I'll ask the final question. We'll ask the final question for you, Henry. Does the nuance guarantee that you are the only company registered under that name all over Canada in case you want to go inter-province to register?
Correct. So the nuance search is very powerful. It shows names that are registered across the board, Canada, so all the provinces and territories, and it also shows registrations of trade names. Okay, so when you say doing business as Pinoy Resto, for example, those will also show in the nuance. So you will see their names that are similar to your name. So it's your choice. Are you still going to use that, or are you going to think of another name? But answer to that question is yes. It does show the search being as of all provinces and territories.
All right. So thank you very much, Henry. This has been a very informative session, and thank you for your kind indulgence of answering all these questions. So before we conclude, can I request the Consul General for his final remarks? Consul General Patron, please.
Yeah. Thank you, DCG Vic. I see some positive comments here, thanking Henry for that excellent presentation. Thanking the PCG for organizing this webinar. As I mentioned at the beginning of this program, this is our way of helping our Filipino entrepreneurs here in Alberta and Saskatchewan. So I'm glad that you liked what we did. This is our first venture into economic and business topics during a webinar. We'll follow it through with a webinar on Philippine franchising next month. So we hope that there will be more of us next month. Now that you have seen how useful, informative this webinar is, I hope that we can seek your help in terms of promoting this webinar of the PCG with the fellow Filipino entrepreneurs that you know, or your business partners. Because at the end of the day, what we would like to achieve here is that more Filipino entrepreneurs are empowered with this important information in setting up a business, in running a business, in knowing business opportunities for all of you. So the Philippine Consulate General will be there to provide those services and assistance for you. But you will be the entrepreneurs, you will be the businessmen. But we all hope that you will be successful in whatever business venture that you will pursue. So maraming salamat po for staying with us until this time. And we hope to see you again at the next webinar of the Philippine Consulate General in Calgary. Salamat po.
Thank you, Consul General Patron. Before we end this webinar, may I kindly request everyone to open your cameras for our Zoom class picture. Vice Consul Steph, can you please ready with your fingers to take the photo?
Okay, if we can request again, everyone, to please turn on your cameras. Okay, 1, 2, 3, smile. One more time. Okay, 1, 2, 3, smile. Okay, I think we're good.
Thank you very much, everyone. And with that, good night from Calgary. Stay safe.